Yo, what's up guys, welcome back to another video. This is a reaction to how private equity consumed America. I did search beforehand like what private equity is because I've heard the term but I don't really know what it is, and companies like BlackRock etc popped up, and from what I know BlackRock pretty much just control, like they're like basically they control all the big corporations, so they'll own whether it's like stakes or they'll own outright like things like YouTube or Google. Like they're like the top dogs really, from what I know. That I guess equity firms and stuff. But yeah, I mean that's sort of the limits of what I know. I don't really fully know how it really works, bar that. So I mean I know Blackstone, and then there's just other ones like that, I guess. But I feel like Blackstone are probably the biggest. But anyway, we're gonna check this out and see what fully this is about, because I have very minimal knowledge on this in general. And that's pretty much it. Links also in the description to my Patreon, where you can see reactions that I can't post to YouTube. And yeah, let's check this out.
Private equity is a great idea, in theory. Funds take investor money, buy a bunch of fledgling or faltering companies, shuffle around their structure and leadership and operating model, grow their worth, then sell them a few years later for a profit. What's wrong with that? For example, do you remember Yahoo? In the early 2000s, it was an icon of the early internet. It was
That's basically Google before Google, right? Yahoo. I mean, it's still about, isn't it? Unless it's actually just died now.
Consistently worth more than Amazon and Apple combined.
Jeez.
Its market cap reached a high watermark of over $125 billion. But today, it's known for what it isn't. After rejecting a $44.6 billion purchase bid by Microsoft in 2008, a decade of decline led to its eventual sale to Verizon for a humiliating $4.8 billion.
Especially with inflation, they messed up big time.
Verizon then merged the company with AOL, previously bought for $4.4 billion, but after the downward trend continued, Verizon finally sold the combined company for just $5 billion. An enormous loss. The buyer was Apollo Global Management, a behemoth private equity firm previously headed by Leon Black until his $158 million in payments to Jeffrey Epstein emerged in the media. Through the years, Apollo has owned and transformed companies like ADT, Chuck E. Cheese's, Qdoba, and AMC Theaters, but this time, they believed there was value to be had in the beleaguered web services company, Yahoo. For their strategy to work, they needed a leader, and for that they turned to experienced businessman Jim Lanzone. Part of the reasoning was surely that this wouldn't be the first time Lanzone attempted to turn around a faltering internet business. He made a name for himself while working at
Ask Jeeves. I remember seeing all this stuff when I was a kid. I'd just go on my computer and these weird browsers, search browsers or whatever you call them, would pop up, and I wouldn't know what they were. Like, I would just want to go on Google. Ask Jeeves. What other ones are like this? There's Ask Jeeves, there's Yahoo, but there's other ones that are definitely a lot more obscure that must be gone now. And I can't remember what they would be named, but there's other ones that I remember seeing as well.
Ask.com. The company started as Ask Jeeves, an early and promising competitor in the search engine space focused on natural language processing, much like today's AI-driven chatbots. Google, of course, won that competition, so the company pivoted its business model to center on questions and answers rather than search, and correspondingly rebranded as Ask.com. It was around then that Jim Lanzone was appointed CEO, and while always overshadowed by the company's fall from its promising early days, Lanzone was recognized as having finished his term as CEO with the company on firmer footing, and is therefore credited for its continued survival. In the years that followed, Lanzone went on to lead CBS's digital business leading up to its massive merger with Viacom, and then was briefly CEO of Tinder in 2020, so Apollo believed he had all the experience for the job. This new leadership team, CEO Lanzone and investor Apollo, started by selling off extraneous yet valuable assets Yahoo had acquired through the years. They wanted to focus on the company's core rather than just acting as a collection of random revenue-creating resources that managed to survive through time. So the key assets of the comparatively strong and independently operated Yahoo Japan were sold off to its other owner, SoftBank, for $1.6 billion. Then Edgecast, a streaming technology company that the former owner had grouped into the Yahoo AOL merger, was sold for $300 million. With just those two sales and the $2 billion they brought in, Apollo was reportedly able to more or less recoup what it had borrowed to finance the purchase of Yahoo in the first place. The key next step was facing reality. Recognizing that Yahoo was no longer truly a search engine, it was no longer an internet homepage, and it was hardly even an email provider anymore. Really, Yahoo was simply just whatever still worked. And what worked was clear: Yahoo Finance and Yahoo Sports.
Yahoo Finance? Didn't even know they had finance. Yahoo Sports, I've probably seen that before. I mean, again, I don't use Yahoo, but my girlfriend's email is Yahoo. So, I guess it means they've got some sort of use there to a degree, maybe. I mean, it's very weird. I mean, I'm kind of confused why Yahoo would be your option, but it doesn't really matter at the end of the day.
Through the years, each had maintained and gained a reputation as the best places to go for investing in sports, news, and data. So to double down on success, they once again hired from experience. Ryan Spoon's time at ESPN and BetMGM gave him context into the fantasy sports audience that drives so much of Yahoo Sports' traffic, so he was tapped to be that division's president. Tapan Bhatt's time as chief product officer of NerdWallet informed his experience in the wants of the newest generation of retail investors, so he was appointed to general manager of Yahoo Finance. Structurally, within Yahoo, each of these core divisions was given a high degree of autonomy to build out unique product offerings for their specific customer bases. Yahoo Sports started work to bolster its sports betting offerings, including acquiring sector startup Wager in 2023. Yahoo Finance focused on growing its subscription-based offerings, and its Yahoo Finance Plus platform, offering advanced trading tools and data, is reported to now have more than 2 million customers and double-digit year-over-year growth.
Oh my days.
The details of what Apollo and this new leadership team are doing go on and on, but in short, Yahoo has gone through a transformation marked by cutting off its appendages, reinforcing its core, and it's working. While obscured by the lack of reporting requirements due to its private ownership, all indications suggest that the company is, while smaller, as healthy as it's been in decades, and the CEO has said that it's on the path towards IPO and is, quote, very profitable. However Apollo exits this investment, it will almost certainly yield them a tremendous return. And it'd be fair to argue they will have deserved it. They came in, took a risk, found a new leadership team, developed a viable strategy, then shepherded the company through a transformation. They took an obsolete institution and brought it back into relevancy. And this is exactly what the private equity industry would like you to believe private equity is.
Okay.
Structurally, private equity firms are not complicated. Their cores are the general partner. General partners typically know the right people. It is not an entry-level job. To take the example of a rather random, rather unremarkable firm, J.W. Childs Associates was founded by general partner John W. Childs after a long and successful stint at Thomas H. Lee Partners, founded by Thomas H. Lee. Thomas H. Lee founded his firm after a long stint at the First National Bank of Boston, where he rose to the rank of vice president. Other examples of private equity general partners include Mitt Romney of Bain Capital, who was also the 2012 Republican nominee for president, and Steven Schwarzman of Blackstone, the 34th wealthiest person in the world.
Jeez.
These connections are crucial thanks to step 2 in the process: raising money. Typically, general partners start by throwing in a couple million of their own money to set the stakes, then they'll go around pitching investors on why they're the best person to manage the investors' money. Often it has something to do with having particular experience in a particular industry that is particularly attractive for particular reasons. In the case of J.W. Childs, he likely went around arguing that he had a particular knack for investing in consumer food and beverage companies, since at his prior firm he had helped arrange the buyout of Snapple for $135 million in 1992, which his firm sold 2 years later for $1.7 billion after massive revenue growth.
Damn.
And he'd likely argue that food and beverage companies are great for investment since people have to eat and drink, and therefore the sector is less subject to the cycles of the market than something like tech. This sort of stability is particularly attractive to the massive institutions that make up the core of private equity investors. In John W. Childs' case, insurance companies like Northwestern Mutual, or employee pension funds like the Bayer Corporation Master Trust. Individuals can theoretically invest in PE funds, but only if they hold enormous wealth. It varies dramatically, but many funds have minimum investments upwards of $25 million. Meanwhile, the way private equity firms themselves make money is remarkably consistent. They just take 2% of it. 2% of all money each year is taken as a fee, regardless of whether or not the firm actually grows the investment. But then to incentivize returns, the firm also sets a benchmark, called a hurdle, that they're aiming to beat in year-over-year investment growth, say 7%. Any money earned on top of that hurdle is then subject to a 20% fee that goes back to the firm. So say if a fund was originally worth $100 million but grew to $110 million, $3 million would be subject to that performance fee, and so 20% of it, $600,000, would go back to the firm. In practice, what's earned from the 2% base fee is fairly consistent since there are generally restrictions as to when investors can take money out of the fund, so the sum does not generally fluctuate rapidly. Therefore, firms typically earmark this base fee for covering basic operating costs like office rent and analyst salaries. But how much is made from that 20% fee varies enormously. Some years it could be nothing, others it could be yacht money, especially since the gains from that fee are generally distributed primarily to the general partner. This is how general partners like John W. Childs become billionaires. And even better, the money from these fees is not considered traditional income by the American tax authorities. It's considered capital gains. Despite the
So they don't have to tax it or what?
fact that these earnings do not truly come from investment by the general partners themselves, the IRS treats them as if they do, and therefore only about 20% goes to taxes.
Oh damn, so it's still taxed, but a very low percentage of it. Flipping hell. I mean, they're living the dream then.
Versus the 37% they'd pay on traditional income. So, considering it's the primary source of their wealth, the general partner is massively incentivized to maximize their firm's gains, and to supercharge this to the next level, they almost all rely on one simple trick. They don't actually invest their own money, at least primarily. Now, if a $100 million fund bought a $100 million company and increased its value by 25%, they'd gain $25 million. But if a $100 million fund bought a $400 million company and increased its value by the same multiple, they'd gain $100 million. They'd 2x the fund's value. And believe it or not, a $100 million fund can buy a $400 million company as long as they have a friendly banker. This is what's referred to as a leveraged buyout. The fund puts in some of their money, but...
So they get a lot of it in like loans, right? But then they put the loans on the company they buy. So they'll buy the company, I guess put a portion of their own money, loan the rest of it, and then the debt will go onto the company that they're basically buying. That's basically how it works? I know how it sort of works to a degree, but I don't know if it's necessarily always put onto the company you're buying or how it works there.
Primarily relies on borrowed money to pay the seller, just like a home buyer with a mortgage. This magnifies the potential earnings, but in turn, of course, the potential losses. But it's worth considering what this does for the general partner. In a $100 million fund buying a $400 million company with 75% borrowed money, very small margins of growth can make all the difference for this one individual. With a 7% hurdle and 7.5% growth, 20% of the margin above 7% on that $400 million company would earn this individual $400,000. But if instead the company reached 7.75% growth, the general partner would earn $600,000. Because of this amplifying effect, every 1/4% growth, a rather small difference, earns the general partner another $200,000 in income. It's also worth considering that it really doesn't matter exactly how this value is created. For every miraculous Yahoo turnaround story, there's a Marsh Supermarkets.
I've heard of Marsh. I can't remember what it was. Was Marsh? It says supermarket, but I don't know how I'd have known of a supermarket called Marsh. I was thinking maybe something on the internet, but...
At no point did Marsh reach the size or level of national ubiquity as Yahoo. If you aren't from Indiana or Western Ohio, you've likely never heard of Marsh Supermarkets.
Okay, maybe I'm thinking of something else then. It sounds familiar, but maybe I'm just thinking of something else that was a similar name.
Yet, while confined to just 2 states, Marsh Supermarkets and its private equity takeover exemplifies a pattern that spans all 50. The first Marsh opened here, a small local grocer catering to specific local needs in Muncie, Indiana in 1931. The simple concept took. Weathering the Great Depression, then outlasting World War II, the budding Indiana institution began to expand. By the 1950s, there were 16 Marsh locations across the state. By 1952, there was a Marsh distribution center in Yorktown, Indiana, and by 1956, the store was expanding into Ohio. As demands changed in the 60s, the company adjusted. Marsh food liners became Marsh Supermarkets, growing in size to accommodate one-stop shopping. Diversifying as decades progressed, the company also established its own convenience store, the Village Pantry, its own bargain bin store, Low Bill Foods, and eventually purchased its own upscale grocers in O'Malia Foods and Arthur's Fresh Market. Blanketing urban and suburban Indiana and Western Ohio, Marsh and Marsh properties were a mainstay through the 90s and 2000s. And it was at about this time that Sun Capital became interested in the company. Today, there are 0 Marsh locations.
How do you mess up a supermarket so much that you've ended up just finishing the company off? I mean, it's a supermarket. Surely that's always in demand.
In 2017, unable to keep up with rent payments and struggling to pay vendors, the company filed for Chapter 7 bankruptcy, closing every last location and liquidating all remaining assets. Like an empire spread too thin, Marsh had reached its territorial epoch before collapsing in on itself within just 2 decades, all on a timeline that rather neatly lines up with the brand's time under Sun Capital's ownership.
Damn.
Now, Sun Capital Partners didn't instigate the regional grocer's fall from grace. Prior to the sale, Marsh had expensively failed to expand into Chicago, it had felt the revenue squeeze from encroaching box stores, and it watched Kroger's parade into its grocery market. In response, the company began to fall behind, failing to modernize its stores or products, backing out of sponsorship deals with the Indiana State Fair, and opening itself up to the possibility of selling. In an atmosphere of supermarket consolidation, though, there wasn't much interest in the struggling chain. Not until someone noticed in a footnote in the company's financial report that the company held a rather robust real estate portfolio. A $325 million purchase point then became more palatable, and in early 2006, Sun Capital jumped, paying $88 million in cash and assuming $237 million of debt.
Okay.
To Sun Capital, the deal was a can't-lose proposition. Either they'd turn around and flip a bloated business, or they'd sell the assets which just in real estate have been estimated to be worth $238 to $360 million. Under new ownership, things changed quickly. They paired management, they sold the company jet, and with the money saved, they renovated storefronts. Sales went up. Then came more maneuvering, but less the kind that would help bump sales. Almost immediately after Sun Capital took over, store locations went up for sale. This one for $750,000, this one for $2.15 million, and this one for $1.2 million. They'd stay operating as Marsh stores, but they'd now be paying a lease while Sun Capital would collect an unspecified commission on the sales. They even went as far as selling the company headquarters for a reported $28 million before then straddling the grocer with a 20-year lease increasing on a 7% clip every 5 years. This maneuver is called a sale-leaseback, and it's quite common in private equity because, at least on paper, it makes sense for both parties. Marsh Supermarket properties were no exception, as they could boost dividends or provide capital for another leveraged buyout for Sun Capital, while also helping the grocer to pay down debt and provide investment flexibility in the short term. But as for the consequences accompanying that long, escalating lease on company headquarters, along with cost-saving moves like carrying name-brand products, cutting staff, and contracting out more and more services, well, Sun Capital just hoped it wouldn't have to deal with them. As of early 2009, news bubbled to the surface that they were trying to sell the grocery chain. But to the dismay of Sun Capital, the new, leaner, streamlined Marsh just wouldn't sell.
That makes me happy. They sort of messed the company up for their own gain, and then they ended up destroying the company, and in turn, I guess, lose a lot of money from that. That's a nice little satisfying end to this. I say end to this. I'm wishing on people's downfall here pretty much. But I mean, look, it's not like, I mean, it's a food supermarket, right? It's not like I don't know if there's a sentimental feeling to like a supermarket as there is like a sports team. Like when someone buys a sports team in this sort of same way, they buy it on like a leveraged buyout. They put that team into debt, and let's just say this is just a theoretical sort of scenario, but I know this stuff can happen. Yeah, and they're taking dividends out every year. And then let's just say the club, the football team or the sports team hits financial trouble and they go bust. That is a more sentimental feeling to like the people of the city, the history of the sports team that maybe their families have all supported and stuff like that. I don't know if the same feeling would be for a supermarket, but you know what? If you're trying to sort of milk it dry to this degree where you're just putting a company like that's like making the company strain money wise because you're just trying to get all the money possible. And I guess you end up messing up and then losing a lot of money out for yourself because you've milked it too much or whatever it is. It's a little bit satisfying, but I don't know. I guess these are just people at the end of the day, very rich people, but hey, it happens, man. Next time you'll learn from your mistakes and you won't milk the company dry to the point where you can't then sell it.
Ultimately, the new owner business boost was short-lasted, and in 2017, the grocer would go out of business with Sun Capital at the helm until the very day it filed for bankruptcy. To Sun Capital, failing to sell was a missed opportunity and a company overhaul that they would deem a loss, as the group ultimately came $500,000 short of recouping their investment into the chain grocery store.
Jeez.
But even in a loss, the private equity firm won. They still collected their management fee each year of ownership, after all. They also collected their commission on sold assets as the company spun off its property at seemingly every turn. Really, the only loss was that they just didn't win more. The same couldn't be said
I'm saying this, yeah, exactly. They still made their money.
about the consumers or employees, though. Deeply embedded in Indiana and Ohio's urban areas, Marsh locations provided healthier, fresher alternatives in areas at risk of fading into food deserts.
So this is kind of what I was wondering then. Is this like a sentimental feeling to the people here? Like, obviously there's history here with it in this area. And if it was just a better alternative to a lot of other shops, then that is a shame. Because, I mean, who doesn't want like the better alternative sort of types of foods and options that you can have at a shop like that? And now you're going to be stuck with, I assume it was replaced with like a Walmart or a Target or whatever, or Walgreens. So I guess maybe they still have the same options, but hey, it was obviously ingrained, especially in Indianapolis. So sad to see.
Beyond nostalgia,
Or Indiana.
residents who lost their local grocery and pharmacy were mad, confused, and lost with the disappearance of a longtime local institution. Then there were the people that worked for Marsh. According to Washington Post reporting, at the onset of Sun Capital's ownership, only one of 3 retirement plans was agreed to be fully funded by the new ownership. Unsurprisingly, the executives' plan. As for store employees,
How is that allowed though? How can they get away with this? Surely there's like laws that should stop this from being able to happen.
their pension went underfunded by some $32 million, which fell not on Sun Capital to even out, but to the government insurer. As for warehouse workers, Marsh owed some $55 million at the time of bankruptcy to their pension, which was already struggling to pay out full checks. Ultimately, Marsh Supermarkets as a business and Sun Capital as a private equity firm are relatively small potatoes. But their ill-fated 11 years speak to a larger pattern in American life. Private equity quietly maneuvers, takes over, reorganizes, and moves on while consumers and employees grapple with the consequences. Private equity fixates on industries, regional grocery chains like Marsh, casual restaurant chains like Red Lobster, odd-end industries like animal retail and veterinary care, and most unnervingly, the most consequential industry of them all, in healthcare. In most cases, only the sharpest-eyed consumer notices the subtle changes, but frequently enough, private equity's internal tinkering turns things sideways. The local market goes out of business, the menu items track upward in price, the understaffed and overpriced veterinary clinic's care drops in quality, the elderly home staff unintentionally neglects a call for help. All this happens in the name of efficiency gains, cost-cutting, and corporate streamlining. Bad outcomes not even private equity firms can deny. On average, headcount at public companies bought by private equity shrinks by 12% over the following 2 years, translating to thousands upon thousands of layoffs.
So in the grand scheme of things, whenever this happens, it's not good for the people of the company. That's just how it is, really, because they're instantly trying to make more money than possible, like more money as much money as possible. So that obviously involves sacking people, firing people, whatever it is, to try and cut costs, pretty much.
PE-owned nursing homes see 11% higher mortality rates than the non-PE-owned counterparts, summing to a total of 1,000 excess deaths per year. Companies acquired by private equity firms through leveraged buyouts are found to be 10 times more likely to go bankrupt in the following 10 years than those that are not. Theories abound as to why a benign structure leads to such malignant results, but none are surprising. They all have to do with what happens when one shrinks a conglomeration of hundreds or thousands of people, their relations, their creativity, their capabilities, their faults, their everything down to a deluge of figures on a spreadsheet. The stories of a private equity firm going in, working on the human level, changing the fundamental culture of a company in a way that strengthens collaboration, creativity, innovation, towards the end of just creating a stronger, more competitive product for their customers, are tough to come by. The stories of a private equity firm going in, hiking pricing after their analysts told them that they could, hiring lobbyists to create more favorable legislative conditions, initiating mass layoffs for divisions that are not yet profitable, saddling companies with debt and complex financial maneuvers, shuffling assets around to create the illusion of transformation, sacrificing future potential for present-day returns. Those stories, and their calamitous human results, go on and on and on. Exploitation is easy without emotion. When the person making decisions is the same person unlocking the door each morning, it is much more difficult for them to profit off of their employees' suffering. They have to face the consequences of their greed face to face, and that's uncomfortable. When the person making decisions is the boss of the vice president whose senior associate manages the associate who sits on the portfolio company board who appoints the CEO whose direct report manages the division whose vice president manages the regional manager who oversees the branch manager that unlocks the door each morning, exploitation in the name of profit is easier. And those small number of individuals at the top, the general partners, have all the incentive in the world to exploit on the margins. Because the compensation model, the industry is focused on growth at all costs. After all, without gangbusters growth, the person whose name is on the sign doesn't get paid. And finally, with a massive 20% of over-hurdle performance multiplied by leverage then paid out to the firm, tiny margins of difference, say outsourcing HR to a third-party firm that is less effective yet cheaper, make all the difference on the general partner's annual income. The incentives push towards brutality. Then this brutality is shielded by layers of bureaucracy, and finally, the US government rewards the brutality by subjecting the gains from it to a lower tax rate. It's a great system, assuming you happen to be the general partner of an American private equity firm.
Jeez, man.
As you may know, the latest fixation of the finance world, even beyond...
And now he's securing the bag, get that money. It is fascinating how this is just such a normal thing. Like, it just happens now. And I guess a lot of times when companies go bust, it could be down to private equity firms. I mean, I don't know how often that would be the case. Like, if they are like the sole reason for a lot of big companies like failing and stuff like that, because I assume there's cases where it's just the company has just struggled for years and then it just dies out. But maybe it's more common when it like. Then I realised that like someone over the top who's then recently taken over, like aka a private equity firm, has basically just, like I said, sucked the company dry, and basically taken everything out of it like that was possible, and then it's just fell apart. The company, private equity is basically just house flipping, but for corporations. Yeah. The only reason I heard of Marsh in 1974, the very first laser scanning UPC barcode system for a grocery store was a Marsh in Troy. I've heard of Marsh, but I think oh, there's a Marsh building in the Marsh, Norwich. This is what I'm thinking of. This building, that's literally about to be demolished. This building is literally in the process of being demolished. That's how I know of Marsh. I knew I'd do it from something, but I was just so confused. This is what Richard Gere, or have you said, in Pretty Women did for a living. Also Martin Sheen and Charlie Sheen in the movie Wall Street. Edit Michael Douglas was the private equity guy. Thanks. So Wolf of Wall Street, that's to do with like the stock market and stuff, from what I remember. Is that anything to do with private equity as well? I guess they sort of go hand in hand to a degree. I don't really know. But was Wolf of Wall Street, because I know it's basically just them scamming people. But was that related to private equity, or was that just more so on, I don't know. But yeah, I mean, this is an interesting video, a little look into the control that these big corporations have. And yeah, I know like BlackRock, for example, they like basically can decide what people are allowed to say and what they can't say, which is why YouTube is sort of seen as so strict, right? In a degree, there's no like sort of freedom of speech on YouTube, because I think it's like BlackRock, maybe YouTube is someone else, but they will dictate what they want to be said on the things that they own, and that in turn is what is allowed on these websites or whatever it is. But yeah, that's that. Until next time, like, subscribe, and peace.